I am Christina Suter, and this is the Real Estate Breakthrough Show, where we talk about the reality of real estate, the mindset you need in order to face the reality of what it is, and tips and tricks to get you moving forward in investing. I am your host, Christina Suter.
So the first way I kind of explain investing to people is, you're starting out and like, here's a big mountain that's way up here. And then it's got different valleys. And then you start and then you go up and you're at the top of a cycle and you're at the top of the peak. And then it's going to go down again. Now, when it goes down again into that valley, it's not going to be where you first started out, but it's going to be higher. And it's just going to go up like this over time. The key is where people mess up is they get over leveraged in a bad part of the cycle and they can't hold on until the recovery comes back up. And that's where people get their ass kicked, and they don't have the experience to know like how to properly plan for seeing what cycle everything is at, because you have so many things going on. You have the economic cycle, so you have the United States cycle, and then you have the global economic cycle and how the other countries are doing, around the world. And then you have the individual asset class cycle. Then you have what's cycling within individual markets. And then you have the debt cycle, like what are the interest rates doing? And so you have all these different things going on at different periods of time, and you have different real estate asset classes cycling at different periods of time. Take, for instance, multifamily. I'm on a forum, like 15,000 posts and everything, and I told them, multifamily cycles. It has, it's a game of chairs. Don't massage debt to make a deal work, because a lot of these multifamily syndicators, they'll leverage it up to the hilt because they don't have to raise as much money, and by raising it to the hilt, they can try to do on the pro forma 1 or 2% higher preferred returns to suck in the people. We have a saying, pigs get fat, hogs get slaughtered, right? And so they buy into that. Well, now these syndicators are hemorrhaging. They're losing tens of millions of dollars of the investors' money, right? So my first rule is a deal has to stand on its own. If you have to massage debt and do interest only, or all this kind of exotic crap or short-term debt to make the numbers work for you, then you're overpaying for that property. It's not the right property. So when the interest rates were down at 3.5% and triple net was trading at 5 caps, I had my clients get the 10-year fixed debt at that time. So they could get 20, 30 basis points lower and have a floating or only do a 5-year. But because I know in the real estate cycle period, give yourself the max amount of time. So your income, because I look at like their income from their job or the business versus the level of property they're buying. They're buying a $3 million property. They're putting 1.7 million down. They've got $1 million and something left to pay off. They're making 400,000, 500,000 a year, plus the stuff from the other investments. If the interest rates go up high unexpectedly, like double, like they did, they can pay it off early, and it's not a big deal for them, right? So I look at how much they have to stretch to buy that deal, and should they be buying that deal. I get people all the time. They're like, I got $500,000 and I want to buy a triple net. Well, no, you don't. Like a $1 million triple net property is like $100,000 house in residential, is what I tell them. Like, it's gonna be a weak tenant, tiny town, and it's gonna be a bad investment for you.